The idea is not that we will have regular series of people talking about investments. The idea is to bring together alumni who are interested in personal investments and to get them to talk. And so, in that way, the WhatsApp group is going to be the center of this group, this series. Very soon after these people have come and talked about it, we are not looking at these people as experts who will be providing advice or opining on day to day. If they have the time and the inclination to do so, they will come and participate. But this is an opportunity for the alumni community to come and learn from each other, come and discuss happenings of the day. It could be financial happenings, it could be something else that relates, that affects the markets. So that is, it could be political events that could affect the markets and so on. So it's basically a discussion place. Now, there are two main reasons I thought of this, and one is that our financial based seminars or webinars, Zoom calls have always been extremely well attended, and today is no exception. Even though we have currently 98, but more than 340 people registered. And there are, I think, close to like 390 people in the WhatsApp group. So this is a area that is clearly close to alumni hearts, and we are looking to have them engage with other alumni in these kind of interest-based groups, right? So we have started a couple of interest-based groups in the past, one on photography, one on astronomy. This is going to be our third interest-based group. The fourth one is coming up very shortly. At the end of the month, we will bring together people who are interested in quizzing. And that is something that is close to practically most of IIT alumni, IIT Madras alumni. And this will start end of August. But what I'm looking for is for after, as the series progresses, the people, the alumni themselves, bring the group alive with discussions, opinions, and reactions, and so on. So, with that said, happy to hand over the floor to Naren, and looking forward to hearing what he's got to say. Thank you so much, Naren.
Thank you very much for this opportunity. It's a great pleasure to talk to IIT Madras alumnus. And I believe that there is a lot that we have learned in IIT. I had the privilege of working with all my classmates who are very, very talented, many of them much better. And there's so much that we learned in IIT which helped us in our entire careers, in my opinion. So I must thank Sridhar for giving me this opportunity to talk on the field I've been working in. So I have been almost continuously working in financial services and capital markets and then stocks, etc. So, the first decade, between 89 and 99, I would say was a period where initially, when you come into IIT, you think a lot on arithmetic and you think investing is arithmetic. And later you realize after the first decade it took me between 89 and 94, market just went up. So, you got even more confident that it is arithmetic. But then when the Asian financial crisis hit in 1997, you realize that investing is not arithmetic. It's not deterministic. It is much more probabilistic. Not that we didn't learn probabilities, but I would say that it is much more probabilistic than deterministic or arithmetic. So one of the beauties about investing, which people don't realize, is it is impossible for anyone to get everything right. And it is only the hope is that you get a good number of the calls right, but it is impossible for anyone to get it right. Like I tell in other events, there were two people in India who knew what would happen to the market the next day. One was Harshad Mehta and another was Ketan Parekh, and both went to jail because they were very, very deterministic in their attitude towards markets. So one of the key things that we have to remember as an invest in investing is you don't get everything right. You have to get more things right than wrong. And when you get more things right and wrong, and the amounts that you put when the things that go right is higher, you have actually won it. So due to this, I've over the last few years, ever since the Indian equity market has attracted the interest of many people, I've been telling people that actually one should not be a full-time investor. Except in the area of HFT, that is high frequency trading, where I know a number of recent alumni are full time investors. I am a believer that being a full time investor is something which doesn't work. Even if you look at the biggest investor from IIT Madras, who's known all over the world, Prem Vatsa, I would say he's not a full-time investor because end of the day he runs an insurance company and he invests because of the amount of money that he has in investment. So consequently, he's not a full-time investor. And even a legend like Warren Buffett, he started so many operating companies because he didn't want to be a full-time investor. Because a full-time investor has a good chance of losing money because the person who is actually starts investing needs returns immediately. Then, so I have seen periods like I would say almost from 95 to 2003, period between 2008 and 2013. And if you look at value stocks between 2018 and 20, all these kind of periods actually markets gave no returns. And therefore, what happened was that if you tried to be a full time investor, it hurt because you didn't get returns each year. Like if you look at it, 2018 and 19 and 20, all 3 years were very bad for value stocks. The returns came in 2021 to 24, but people could not have been patient if they were full time. If you're part time, you can be patient. If you ask me, is a mutual fund CIO like me full time? Yes, I'm involved full time, but we don't sit in front of the screen from morning to evening. So we are actually not full time because we have got compliance work to do. We have got all other work in our organizations to do. So the advantage is we are full time managing money for other people, and that's why it is full time, not because we sit in front of a screen from morning to evening, because that is a very bad thing to do to make money. Except in HFT, which I high frequency trading, on which I have zero knowledge. Why is investing such an interesting field? Because if you look at all the trades in the secondary market, they're all zero sum games. Suppose somebody sells a stock to us at 100 rupees and it goes to 200 rupees. The seller of the stock has lost money, you have gained. So most of the trades that happen in the markets are technically zero sum game, and that's why it's such a difficult game because only one side of a trade in the stock market normally invests. Of course, it could be interpreted that if stock market goes up, everyone makes money, but that is a different kind of thing. So in the 21 years that I've been a fund manager and 10 years in stockbroking, one thing we learned is the most important thing, which Warren Buffett also keeps saying, is temperament and not IQ. Because it is temperament which decides whether you will make money in the long run or you won't make money in the long run. And people think that to make money in markets, you need to be extremely good in numbers. Actually, the learnings are very clear that you have to be you should have good common sense and you should have a very good temperament. Because if you, I have, there is a person called Arun Kumar who recently called it ABC as the way to make money in the markets. So A stood for asset allocation, B stood for what did you do in bubbles, and C is what did you do in crisis. These are the three things which matter to investing. So, what is asset allocation is if you take all the assets, whether it is equity, debt, gold, real estate, it can be even REITs, InvITs, etc. You have multiple asset classes, and what asset allocation means is you are invested in all these asset classes. Ideally, you choose to invest more in the asset class which has done badly and then choose to take out money from the asset class which has done well. You will be surprised to note this looks very logical and very simple and clear, but people don't do it. if you take the 21-year history of my mutual fund career, the amount of money that came into gold ETF and silver ETF was the highest in January 2026. And if you look at it, at that point of time, gold and silver had done the best, and they were at all-time high. And surprisingly, what happened was that that was not the time when money went out of gold and silver. That was the time when money came into gold and silver. In fact, it is the only month in the 21 years that I worked in a mutual fund where the amount of money which came into gold and silver was higher than equity. So this is the irony of asset allocation. Asset allocation involves trying to invest in an asset class which has done badly and take out money from an asset class which has done well. But somehow, due to bad temperament of the general public, the reverse happens. In 2022, gold and silver had not done well. People were not investing in gold and silver. But in 2026 January, when gold and silver peaked, that was the time when people invested. So when people ask me what is asset allocation, I tell them to that it's an asset class which you invest in when it has done badly and take out money from an asset class which has done well. Today, everyone knows that US is the best stock market in the world. It has done the best. So in 2012 in ICICI Mutual Fund, what we did was we actually launched a US fund in 2012. And at that point of time, the 12-year returns in US was close to zero in NASDAQ. So when we launched that fund, we could hardly get any money. Because while people say that US is the greatest country, the greatest market, the market country to which so many people have gone from India, from IITs, but in 2012, when there was a 12-year no return in US, people did not invest in US equity when it was available cheap in India. On the other hand, in 2022, in 2021, right now, there is so much of interest in trying to invest in US equities that every day there are people who call my company and say, why don't you reopen your US equity fund to invest today? But today, US is the best performing market in the world in the last 14 years by a mile. But that is the time when people practice what I call anti asset allocation. Coming to the next bubble is not something which comes every day, and it comes occasionally. I had the privilege of hearing Warren Buffett live in a group of 400 people in Delhi, in the only visit I think he has done to India. So people asked him, one of the questions people asked him, you have spent 40 to 50 years in investing. What is it that you learned out of that 40 to 50 years in investing? So the simple answer that he gave that person was that in 40 to 50 years, there are four times when you had to invest very, very big. And that was the most important thing. So if you look at India, for example, when I have spent 37 years after my 39 years after my IIT Madras career, see, there was periods like 1989, then there was a period in 1998, then 2001. Then, if you look at it, 2008 and then 2020, these were the five times when you had to invest very, very big. So, what was common at that point of time, particularly to 2001, 2008, and 2020 and 1998, is that there should be a big global negative event. So in 1998, it was the Asian financial crisis. In 2001, when the World Trade Center bombing happened, the Indian market crashed, and that was a superb time to invest. 2008, when Lehman failed and many of the banks in US were about to fail, that was a fantastic time to invest. And in 2020, when people said due to COVID, the world is going to get into deep trouble, that was again a time to invest. So frankly, when you have a global crisis which involves multiple countries and it doesn't come every day, it comes rarely. If you look at the period from 1998, it has come only four times. But if in those four times you are able to invest in a crisis in a very, very big way, You are going to make money which is unbelievably large. What is the problem that I have as a mutual fund investor? I don't get money at that point of time. In 2008, we did not get money. In 2020, we did not get money. We got huge money in 2007 when there was the equivalent of a bubble. So, how do you identify a bubble? Again, it's impossible. Whether it's a bubble or not, you will not even know. But bubbles are when you see extreme outperformance of an asset class. I would call January 2026 a bubble in silver, certainly, because silver went up 120% in a year. And therefore, it was something which was absolutely very, very large. So when you have a bubble, one of the ways in which we do it, at least I do it, is that you compare market caps. So if you go to the 2000 tech bubble, at that point of time, the market cap of Infosys and Wipro, each of them was higher than the market cap of the entire cement and steel sector. In 2007, the market cap of DLF was higher than the market cap of the entire pharma sector. And DLF was just one company in real estate. And today, if you look at it in 2000 and you look at many of the US AI companies, each of those US AI companies is worth more than many, many emerging markets and even developed markets which have not been part of the AI trade. Does it happen? Does the problem or does the bubble kind of deflate immediately? The answer is no. Does it mean that the stock which is sold has to do badly? No, it is actually relative. It is that in relative terms, actually DLF did very badly after 2007. Infosys and Wipro did very badly after 2008. 2000 and in 2025 when we look at the numbers in 2026 it looks like whether the US AI stocks do well or not, it is actually the switch which is more interesting than one thing going down. It's possible that the stock which you sell is not equal to the stock, may not do badly, but the stock that you can buy in lieu of that, that does very well. So if you had bought pharma stocks against DLF in 2007, in the next 8 years, you got huge return. If you bought cement and steel in stocks in 2000 when the tech boom was at its peak, you made huge returns in cement and steel stocks in the next 6 years. So what happens is actually a relative trade. This comes to one of the most interesting things as far as investing is concerned. What we have seen is that, everyone tells you when to buy, but no one tells you when to sell or switch. And one of the lessons that we learned out of investing, I learned personally, was that you can never think of a sell, you can think of a switch. And for example, if you had thought about selling, for example, Infosys and Wipro and buying cement and steel sector, that's an easier decision because otherwise you're actually selling Infosys and Wipro when it is doing extremely well in 2000. Similar is the case in DLF. Today, if you look at any of the US AI stocks, so for example, in the go back to 1 month back, each of those chip companies was worth $1 trillion, and you look at it, it is the switch which helps you to make money, and that is it is actually what you will have to think to make money in investing is always switch. This happens across asset classes. So if you look at for example real estate in 2013, it had a long cycle from 2003 to 13. People used to ask us, why did we call it a bubble? Because particularly in Gurgaon, when we used to go to Gurgaon, people used to say we would buy under construction property, which will get delivered in 2020. That was a sign of a bubble. So at that point of time, the best decision would have been to sell from real estate into equity in 2013. And so it becomes very obvious. Again, it will be very obvious from a common sense point of view because people would have made too much money in one area and another area would not have made money, and you would be thinking you're a fool by being in that other area. But at that point of time you have to move from the area where you have made too much money to the area where you actually you have not made money. So if you look at it, people ask me the principal asset classes: equity, debt, real estate, gold. And in equity, there is a valuation and you have past returns. All that is very clear. In debt, also, you can predict when interest rates are high. Like in 1998, you could get 20% in Larsen and Toubro debt. That was a sign that actually that was very, very cheap. But what about real estate and gold? So, we spent some time thinking on real estate and gold. So in real estate case, it is actually comparing rental yields and interest rates. So if you look at the interest rates in the year 2020, interest rates were very low and rental yield was static. So real estate became an attractive asset class. If you go back 3 years back, office rental yield is was one of the highest in the country, and against that, interest rates were very reasonable. So offices was one of the best asset classes. So how you compare it is by taking a rental yield and comparing it with the borrowing. Will it always work? It won't work always, but it has a good chance of working. So why it may not work today in Bombay in some places is there is huge redevelopment in Bombay. Every redevelopment has created a temporary rental demand. Will that temporary rental demand last forever? Answer no. Once the redevelopment of Bombay properties gets over, you are likely to see a different situation. So this is how we look at investing. So if you in 2013 interest rates were very high and rental yield was very low. So real estate was extremely overvalued all over India with the exception of Hyderabad. Why Hyderabad was not booming was because of Telangana and Andhra split at that point of time. So 2013, the cheapest market for real estate at that time was Hyderabad. What about gold? People have asked me because gold does not have either. It does not have interest. You don't get interest. You don't get dividend. You don't get cash flow. And how do you do it? So we used a model which was very simple. Take the market index like Nifty or S&P 500 in US and divide it by gold and silver. That told us to buy in 2022 and told us to sell in 2025 itself. And we didn't get the extra money which would have got from 2025 to 26. So you do a simple ratio between Nifty to gold, Nifty to or S&P 500, US S&P 500 to gold. Similar thing you do in silver. And when that ratio becomes very, very low, suppose Nifty is done very well against gold, you can move from Nifty to gold or Nifty to silver and vice versa. And on that basis, today, neither Nifty or gold is giving up. It's gold or silver is not giving a powerful buy call, but at least it is not as blissfully overvalued as it was in January. The same thing, the renowned investor Charlie Munger mentioned that crypto cannot be an investment class. The reason being because there was no dividend and there was no interest or cash flow in crypto, so he kept railing against it. And neither Charlie Munger nor Warren Buffett ever liked gold. But what happened is that there are periods of time in the world once in Russia's entire dollar assets were seized. After that, most of the central banks said we can't trust only dollar, we have to trust gold and silver also. So the boom that happened in gold and silver happened out of the confiscation of the dollar assets of Russia in the year 2022. Which is the best way to measure this entire bubbles in equity is by comparing market capitalization. You will see an extreme and you cannot use it when it is in the middle. How will you know it is an extreme? When one company in US becomes higher than Germany plus UK plus French market cap, that is a good sign. In 2024, the Chinese market cap was so low compared to India. That was a very, very good sign that China was very cheap compared to India. So comparing market caps in extreme works well. So, what do we think today? When we look at SpaceX, I think Partha, a person, will talk more about it. But one of the best ways to improve investing is by ability to write a journal. For every investment that you do, if you can write a journal, it works very, very well. For example, I wonder what was the rationale for which people bought SpaceX in US, because it would have been very difficult to write a journal, because you would have been writing that all kinds of things will happen in the next 10, 20 years. Then for that, why did you have to buy in 2026? So that the moment you write a journal, you will find that some of your worst mistakes won't happen, because you will find a situation where you are actually doing stupid things. So to sum up, I would say that if the most important thing is greed, fear, and common sense. I call it GFC. It is not knowing everything about discounted cash flow. If you have greed, if in greed you have to be very very careful. In fear you have to be extremely confident and you have to buy. And in common sense you need to use all the time. How does common sense help every IIT Madras alumni to make money? Every IIT Madras alumni knows more about something than me. So let's assume you are in the chip industry. Somewhere in the chip industry, you would have known last year that there is a huge boom happening in chip prices, and the chip prices are going to shoot up. So it would have been very, very obvious that the chip stocks, which had not done well for 20 years, like SK Hynix and Samsung, was a massive opportunity to buy because the chip prices were booming. If you were, for example, in US and you were in an artificial intelligence chip company, you would have known that Nvidia would be was at the vanguard of this entire AI area. And if you had gone into earlier decades, you would have known that Microsoft was doing extremely well and Alphabet was doing extremely well. And everyone was actually getting into social media through Facebook and Instagram. So that would have meant that actually every IIT Madras person has a zone of competence. Let's assume you're working in Tata Steel. You would know that at some point of time, steel prices are too low. So you know that steel prices cannot be so low that everyone loses money. So you can actually make money out of that. And you don't need to do it in your own company because there could be a lot of corporate governance issues. But you can do it in another company. If you're working in Tata Steel, you could buy another steel company. If you're working in a chip company, you could buy another chip company. And it is impossible for any investment professional to know about everything about that sector in which you are working in. Almost everyone in mechanical engineering could see electric vehicles coming, and therefore there were things that they knew would do badly, and there were things which they knew that would do well. And frankly, that is something that has to be done on a continuing basis. And if you do that on a continuing basis, you will be alive to the world also. And you will find that if a group of 10 people with 10 different industries join together, I think you will make the best fund managers in the world, because end of the day, between those 10 fund managers, you would actually have a very, very good knowledge of everything that is happening in all those sectors. And you will actually become a very, very good fund manager. So, one thing I want to add before I finish, there are three styles of investing. One is called growth style of investing in equity. Another is called quality style of investing in equity. Third is broadly you can call value style of investing in equity. Growth style of investing in equity would mean that you actually think AI is going to come, therefore IT services may not do well. So, but something else will do well. So you buy the areas where growth will come and sell the areas where growth will not be there or declining. That is growth style of investing. Can you actually uh, that is one style. The second style is the quality style, which was actually pioneered by Warren Buffett and Charlie Munger. So there you choose quality companies, but you have to remember at times technology can completely disrupt the quality companies. Take an area like print media. There was a time when Warren Buffett and Charlie Munger were completely fond of Washington Post. But what happened is internet actually disrupted the print industry. So if you're buying a quality company, you have to be aware whether any technology trend is actually disrupting the sector. Third is value, where what you do is you buy very cheap. So you look for something which is very, very cheap. So people ask me what is cheapest at this point of time. I tell them Japanese government bonds. Because if you look at it, yen has been an extremely bad currency, and Japanese bond yields have shot up through the roof. So the investors have lost huge money in Japanese government bonds. So I believe that if someone asks me what is value at this point of time, I tell Japanese bonds. Obviously, sitting in India and you don't have an opportunity to invest outside, we tell people choose debt because gold has done well, silver has done well, small cap and mid cap has done well. Clearly, large cap is slightly better, but even large cap has done reasonably well. But debt has done very badly. No one is willing to invest in debt. So a combination of some large cap stocks and some debt would be something that people can consider at this point of time. Real estate has also done well. Offices have also done well. So you are in a situation where, in earlier periods of time when people used to ask us this question, we used to tell people invest in gold. That didn't work this time. So where gold is an asset class which normally does very badly when everything else does well, but this time gold has also done well. So that's why choose debt and choose some large cap stocks which have also done well, like badly, like some of the mega caps. This is what it is. So, to sum up, investing is common sense. People actually make it, but there are times when you have to look foolish. In 2007, if you had said equity will come down, you would have looked foolish. In 2008, if you had bought equity, you would have been lonely. In 2020, when people said the world is closing down, if you had bought equity, people would have looked at you in a particular way. In 2026 January, when we spoke negatively on silver, people looked at us as though we were saying something totally wrong. So in investing, common sense works, but at various points of time, you have to be willing to look foolish in the near term because it is not arithmetic. No one can get everything right. And there are times when you have to be patient. As far as the areas like high frequency trading and algorithmic trading is concerned, I'm unfortunately not the expert, and maybe Sridhar can get someone else who's an expert to talk about it. I have not been in that area, so it's very difficult for me to talk about it. This is what I want to broadly convey. I've tried to keep it as not as non-technical as possible because I have a guru called Howard Marks. He has written about whatever he has done in investing is available in his website called oaktreecapital.com. He uses no jargon. He doesn't use discounted cash flows. He doesn't use price to earnings. In all the mails, and he has written mails from 1990 onwards, and everything is available for you to read. So people ask me, what can you read? Clearly, if you're a growth investor, you should read One Up on Wall Street by Peter Lynch. He was one of the best growth investors in the world. If you are, for example, a contrarian investor, you can read David Dreman. If you want to read something which is completely on the web, I would recommend you to read michaelmobison.com. Has a lot of stuff which is extremely interesting. And you can also read on oaktreecapital.com. And these two things can be read on a continuing basis. If you want to know why you should use a journal, I would say you can read Checklist Manifesto by Dr. Atul Gawande. So this is all that I had to convey. Over to you, Sridhar. Thank you.
Thank you so much, Naren. We've heard from one of the people with such deep experience in the industry, and I think people will be making notes because there were so many profound things that he said that if we can follow in our own investment decisions, possibly they could help us. Now, I want to start. We will take questions. We will look. There have been questions put in the chat box, but I'll get started with a slightly different type of question, right? So when I did an MBA in the late, in '99 through 2002, I was learning security analysis from a guy who was more believed more in the efficient markets, right? So more about, like, there were so there was that philosophy, and then there was also that behavioral economics. So people are not rational thinkers; they make mistakes and so on. So he was firmly of the opinion that You just invest in an index, not actively managed funds index. And I know that I'm asking questions of a person who offers, managed funds. So what do you think about the pluses and minuses of index-based investing versus actively managed funds?
See, one is I don't believe in efficient market theory. After being a fund manager for 21 years and watching US markets and Indian markets, not that I'm an expert on US markets, I'm not a believer in efficient market theory in the sense that, particularly in asset allocation. As far as indexing is concerned, I believe that indexing is a very good model to do, and it guarantees you an average. So, an average at low expense is something to be looked at. As an active fund manager, our goal would be to outperform that index. And, my job would have gone. I wouldn't have been given a 2 year extension if I had not created value against the index during the 21 years that I spent in ICICI Prudential. And I still believe there are pockets of inefficiency which are available. So if you look at the biggest challenge of index, I think the biggest challenge of index is best explained through SpaceX. If in SpaceX it was not allowed to be brought to the index, the IPO would not have happened at such a high price, in my opinion, in US, because they guaranteed a fast entry into the index. The index fund bought without thinking at whatever price it was available on that day. And if you look at it from that price to today, the share has crashed. So I believe that over indexing that has happened in the US market is a big risk, because the whole thesis on SpaceX was that it will be brought into the index 1 week or 10 days after it was listed. And that turned out to be one of the worst ways to invest for the index, because the index does not have a brain. So I believe that in an over-indexed country like US, I think there'll be a lot of problems that can happen over the next decade. Having said that, for people who follow asset allocation, and I believe that indexing is not a bad thing. As far as efficient market theory is concerned, I do agree that index. The problem with index is people use in India they use very 50 share index. And today, mid caps do well. They'll go and put money in a mid cap fund. They'll put money in a junior next Nifty fund. Those are all, I would say, those are all decisions which can go wrong. So it's a nice average way to invest, and I'm not going to say against it. But I think I wouldn't have had a job for 21 years if in that 21 years I had not outperformed the index.
Very nice and balanced answer. Thank you, Naren. Priya, can we go to a few questions from the chat?
Yes, sir.
Go ahead and read some of these questions, please. I
Yeah.
think some of them Naren has already addressed, but some of them which you feel, like, for example, the books he has already recommended,
Hmm.
and um,
So as a long-term investor in ICICI Prudential funds for over 20 years, my biggest challenge has not been selecting funds, but deciding when not to invest. In your experience, what is the single biggest mistake long-term investors make during market extremes, and how can they avoid it? This is from Dr. Subramaniam.
See, basically, what conclusion we came to see, I became a CIO in 2011. And, 2008 to 2011 was a very, very bad period. And what we realized was that we ourselves have to create asset allocation funds. And my job here is not to market any fund. So what we did was we created our own version of asset allocation funds, which itself will sell on a rally and buy on a fall, like the balanced advantage category or multi-asset category or aggressive hybrid category. These are all categories which we created and we call dynamic asset allocation categories. And we created all these categories primarily because of the fact that, we realize that investors will choose to invest in 2007, and in 2008 post Lemon they will take out money. This was the experience of the mutual fund industry in 2004 to 9. So after that, we popularized all these asset allocation categories. And those asset allocation categories, I must tell you what happened in March 2020. In March 2020, the world was closed. Our office was in Bandra Kurla complex in Bombay. So there was a nearby hotel called Trident BKC. So what happened was we put all our dealers in Trident BKC and asked them to walk to our office. And due to that, during the time that the markets were at their bottom, we bought left, right, and center with all the money that we had in these asset allocation funds. And that turned out to be one of the best investments for the investors in those funds. It was impossible for an investor to invest in March 2020, but all the asset allocation funds that we had could invest in March 2020 and reap very good returns for the investors. So, my view after being in the business so far is that you have to choose asset allocation funds. But if something changes in the regulation, maybe there would be other ways.
Thank you, sir. When do you stop backing a specific fund manager? Also, is it ever worth backing a brand new fund manager? From Samir Mehta.
This is a very tough question. See, the way we look at it is, I've run a fund called Value for long, and it had a very bad period between 2006 and 8. And under a colleague took over because I became a CIO. He also ran it badly. The fund did badly between 2016 and 18. So the challenge is that, in my opinion, if you trust a fund manager, you have to back him when he is doing worst, and you should take out money from him when he is doing best. Is that easy? That is also asset allocation, in my opinion. If you can take out money from a fund manager who has done too well, that would be asset allocation. And investing in a fund manager you trust when he is doing very badly is again asset allocation. And that is the framework that I believe in. And so it's tough. Actually, what I'm saying is not easy. As far as a new fund manager is concerned, there's one advantage that a new fund manager has. That new fund manager has very small money to invest. So sometimes they get it right, sometimes they get it wrong. But it's useful to see that person's background. If that person's background justifies investment, even if he's a new fund manager, you can consider. But you have to look at the background 360 degrees.
Okay. What are your thoughts on how Japan and China are selling US treasuries, Mayank?
Because the point is that US has a very high fiscal deficit and current account deficit. And in a top-down framework that we use, no, we normally do not invest in countries where very high current account deficit and fiscal deficit. And logically, it would be logical that a country with a high current account deficit, if another country takes out money, if you remember 2011, 12, 13, our country had very high current account deficit, so rupee depreciated. So, in our opinion, it's a very logical decision to do. One of the reasons why I mentioned that the most contrarian asset class is Japanese government bond is because Japan has a current account surplus, which is big, and a fiscal deficit, which has reduced sharply. So, that is the reason why I recommended Japanese government bond, although there is no way in which you can invest as an Indian through, I do not know a way to invest as an Indian.
At what point of month can we invest in SIP, and how much percent allocation should be done for small, mid, and large cap? From Srujan.
Our view is that you should, any time is a time to invest. But you know what is the problem is people wanted to start small cap SIPs in 2024. And they wanted to start silver SIP in January 2026. So if you start an SIP when something has do well, you should have a 10-year horizon. I'm of the view that people don't have 10-year horizon. And therefore, one of my statements became controversial because in 2024, I told people that there are risks in small cap SIPs. And in 2026, I've told people there is risk in silver SIPs. But the best way to invest in SIPs, I believe in unconstrained investing. I have another guru called James Montier, who has written a beautiful piece called 10 Tenets of Investing. So if you do unconstrained investing, which means that you don't invest in SIPs in small cap or mid cap or large cap, you choose something like asset allocation funds, or you choose flexi cap funds to invest in. That is, or you choose multi cap or something, or you use value or something like that you use rather than invest in narrow areas. Imagine if you had invested in a narrow area like IT in a technology fund, the returns over the last 3 years were very bad. Today, for example, the SIPs on FMCG fund have also done very badly in the last 5, 6 years. If again, in a framework of asset allocation, I am comfortable in some periods. For example, if someone told me I want to start an SIP in FMCG fund, even though it is a narrow theme, I may consider it because it has done very badly for the last 6 years.
So when you say office yields have done well, I see they are at 7% to 10% now. Are you saying that real estate does well when it gives us 10% return? What is the corresponding good return we can expect from debt? What are your good and bad return expectations from these institutional asset classes like debt and real estate? I guess for equities and gold, it can fluctuate a lot more. From Sharath.
Well, my view is that today if you get 7 to 10% office yield, it is an attractive asset class. There is you have the potential of continuous appreciation in rents. So what happens is, and all the all the grade A buildings are actually in demand because of GCCs in all the places. So I believe a 7 to 10% yield in office is a very attractive yield, and it actually makes sense in my framework. Residential rental yield, for example, I stay in Bandra is 1.5%, so I don't invest in it, and I've been staying on rent. It remains very low. So if rental yields are very low, it is not an attractive asset as per my framework.
In your view, do you see Indian government bond included in Bloomberg Global Bond Index in this review cycle? By Guru.
In ICICI Prudential, our debt team, my colleagues in the debt team, who I'm also involved in debt, we believe it will be included. And I think the market is definitely hoping that will get included. If it doesn't get included, it will be a shock for us.
Sell on rally and buy on fall. Does that mean the fund should have used some valuation models like DCF? Because a share price fall may also mean the company's fundamental shift to degrowth.
So we make use of, in our asset allocation funds, we make use of price to earnings as it goes up, and price to book. As price to book goes up, we sell. As price to book goes down, we buy. That is what we are doing rather than DCFs. So what we do is, in a fund which is asset allocation, there are times when the fund can be 30% invested in equity. There are times when it can be 80% invested in equity. It will be 80% invested in equity only when the markets are extremely cheap. And at 30%, it would be when the markets are extremely costly on price to book. That is the framework we've been using rather than DCF. DCF involves too many assumptions, and we struggle with those assumptions.
For companies in emerging techs, how do we get in before the IPO is getting released? Are there any platform or minimum investment requirements?
I'm not in that area, but as I said, no, sometimes it is through friends and relatives, and an idea is good if you can get in, it's best. The private equities which are backed, many of these companies have returned very good returns. But again, I don't know whether from here the returns that will come in private equity in such ventures will be as good as what it was in the last 6 years. Because in the last 6 years, market valuations in India have gone up substantially. And therefore, the investors who invested in such entities 5, 6 years back, they benefited a lot. Whether they'll benefit in the next 5 years or not, I'm not aware, but it's not my core area of investing.
On fundamental analysis of stocks, what are the top 5 to 10 parameters like OPM, ROE, ISR do you like at most frequently? You mentioned Warren Buffett's asset allocation principle. Be greedy when market is fearful, be fearful when market is greedy. But mutual fund can't follow this. 1 year return expectations, etc. How can mutual funds out circuit this constraint? You mentioned dynamic asset allocation. How much relative AUM?
No, actually, you have put a right question. But the fact is that as an asset management company, we have managed to collect a lot of money in asset allocation oriented funds. And luckily, investors have invested with us. I think you're right on what you're saying, but the fact is that end of the day, we always recommend asset allocation. In the last 2 years, we've been keeping on telling people asset allocation rather than pure equity. If you give me money in a pure equity fund, I have to be fully invested because I'm measured against my benchmark. So what you're saying is 100% correct. But we have succeeded in collecting a lot of money in asset allocation funds. Recently, we have managed to collect money in specialized investment funds also. Both these are very interesting categories which don't force us to be fully invested. So that's why I like many of the specialized investment funds also for the same reason.
Given many of us are globally long-term investors based out of US, India, ROW, any overall perspectives on percentage portfolio one would invest in US markets, dollar-based versus Indian-based markets? How do you think about this? Give both US and Indian customers have opportunities to invest across both.
I don't have an answer, but if you're asking me what my personal view at this point of time is, US AI oriented stocks are not cheap. If you are invested in India today in large caps or in debt, it is cheaper. Today, if you take out your money and invest in US, you are investing when rupee is at 96, and rupee has also depreciated a lot. And real effective exchange rate of rupee is also attractive at this point of time. So, because every day somebody calls me and tells me, why don't you consider investing outside? I tell people maybe today is the time when it has become too much consensus. So it is opposite my framework of asset allocation. Can I go wrong? Yes, because no everyone believes in India is not involved in AI trade, and consequently I can go wrong. But this is a framework that we use and a process that we use. So I would be cautious on investing significant amount suddenly today in US. If you're already invested in US and that is part of your this thing, then it is fine because at the end of the day, by just selling US, the capital gains and so many other considerations also come. One of the things which I did not mention in my talk is frankly, Sir Franklin Templeton said that the most important thing is what you make after tax, not what you make pre-tax. Because taxation is a factor also which you should consider in investing.
Given the current concerns around elevated AI-related valuations in the US market, the recent correction in Indian equity indices, and 3 to 4% depreciation of the INR against the USD, how would you approach allocating a lump sum investment across global markets today? Assuming the investor has a low to moderate risk tolerance and a long-term investment horizon, how should they think about balancing exposure between Indian and international equities, considering both valuation and currency factors? What allocation strategy or framework would you recommend in the current environment?
From the points that you have mentioned, I would actually say you should be invested in global debt rather than global equity at this point of time and wait for a correction. And I think the point that was asked by Banti, I try to avoid parameters because of the fact that Quad Marx has taught us that you should not. But since you are telling me, I'll tell you it is return on equity, it is EPS, price to earnings, price to free cash flow, price to operating cash flow, dividend yield, how is the company's capital allocation principles? How confident are you of the business in the next 3 to 5 years? Is the stock overowned by domestic mutual funds or underowned by domestic mutual fund? Is the stock overowned by FIIs or underowned by FIIs? These are some of the points that I would use.
CDX index to bet against US corporate debt actually a good trade right now?
There are people who tell us, but the bigger problem is in this performing credit funds rather than in the main. Do we think that the top companies of US are going to become so risky on debt side? I don't think so. So our view is that you have to be careful in credit in US. In India, there has been no major bullishness in credit at all. So performing credit and all these areas have not seen big inflows. You should be careful investing in junk bonds in US, in my opinion. I don't think you can bet against the top companies of US. The top companies of US are in very, very good shape.
Priya, do we have more questions? Because I know that we've gotten to the end of the schedule time.
Yes.
What do you think? Do we have more? Because I mean, the questions are extremely detailed. I really appreciate Naren having these clear opinions in most cases, right? And he has not tried to hide behind very, very wishy-washy answers. Really appreciate that.
Thank
So,
you.
just wanted to know if there are more questions, or do we bring this to a close now today? I know that there will be a lot more questions that could possibly be put into the WhatsApp group. Any more questions that you want to, let's say a last question, Priya?
Okay. So there are studies that show over long periods 70 to 80% active funds underperform index. How can we choose right active funds that will outperform index?
That is a job of Atul Singhal. He'll come and talk to you next. So you can ask him that question. How does he choose and does it? But I would say that that is not my job. My job is I lose my job quickly if I keep on underperforming benchmark. That much I can
Okay.
tell you, but I
Let
can't tell you
me
beyond.
Yeah, let me add to that. Okay, see, I kind of asked similar question to start this off about index funds versus actively managed, and Naren very cleverly answered, "Look, I've been sitting in this post for 21 years, and the reason I'm here is because I'm doing well against benchmarks, right?" So, for all of you guys, here is a guy who has done extremely well. Our alumnus, we know him very well, and you can see his performance record. So, if this is the time to put more money into Prudential, ICICI Prudential, please do so because of what you've heard from him today. But let me bring this to a close. It's been an extremely interesting session. I really thank Naren for his very clear. I mean, see, you could throw any category at him, and he was informed of this. And I really appreciate the deep knowledge that he has had in this world, and it comes with the territory, of course. But given that he's a CIO of such a
I have to thank
large
my IIT
AUM,
education for it. I have to thank my IIT education.
Absolutely. And like he said, the people, IIT alumni working in different asset classes, different fields, have that inbuilt knowledge that could translate into possibly asset allocations at the right time. Please participate in the discussion group, in that WhatsApp group, and give us your insights of what is happening in your area that you know of, right? So it could be you reacting to anything. It could be you reacting to political news, financial news. It could be anything of that. And let others also chime in. It is with the knowledge of everyone. Let us learn and move forward. So, with that, I would like to thank all of you guys who've participated, come and participated. I'm looking forward to dynamic sessions like this in the future. Our next session will be by Atul Shingal, who is head of Scriptbox. He will come and talk to us more about. He'll follow basically what Naren has talked, and he will get into more depth about asset allocations and different investment vehicles and so on. Thank you so much.
Thank you. Thank you for giving the opportunity. Thank you.
Thank you everyone for joining us. Thank you, sir. Thank you for all your insightful session. It was wonderful. And we keep, thank you so much.